it's important to say that at least 4 times in my career, let's say 4 times in my memory, the price of oil fell below the price of oil fell below the cost of production. So can oil prices go lower, even dramatically lower? Yes. You'll recall in COVID that oil prices went sub-zero before settling out at $20 a barrel. It's important to note that the International Energy Agency suggested that the fully loaded cost to produce a barrel of oil was $60. So the industry would make the stuff for 60, sell it for 20, lose 40, and do it 80 million times a day. This gets rather boring, and the truth is it doesn't last very long. But as an example, to prepare your listeners psychologically to become oil and gas investors, let's imagine, just for fun, that peace broke out between Russia and the Ukraine, and Russian oil and Russian natural gas were allowed to flow freely without sanctions to the West. Let's imagine further that both the Saudis and the Iranians decided to maintain their market share as lower-cost producers pumping more oil to freeze the Russians out of the market and maintain their revenues. Could the price of oil fall from $65 or $70 to $45 or $50 a barrel? Yes. Yes, it could happen. As an investor, you need to understand that. You also need to understand that much of the recent decrease in the price of oil has to do with U.S., not Russian or Saudi production. And that U.S. production is due to a conjunction of technologies that have enabled us, particularly in the Permian Basin in West Texas, to transform the U.S. from the largest petroleum importer in the world to a petroleum exporter, to in fact double production from the most heavily drilled strata on Earth. This is important to understand because I would suggest to you that the gains that have come from the production that exists today have been maximized. That without new technologies around drilling or around reservoir stimulation, that the number of undrilled A-grade locations in the Permian, in the Marcellus, in the Eagle Ford, in the Scoop Stack, the suggestion is that we've probably now drilled 70 or 75% of the A-grade locations. So without either a rapid decline in the cost of capital, which is to say vastly lower interest rates, or improvements in production, that we have probably seen the eclipse in the rise of U.S. production. Let's take a look at something else. On a global basis, the move into the lower cost has been largely a function, again, of the U.S. and the very low cost of capital. On a global basis, it's estimated now that the marginal production takes place at costs that are in excess of the selling price of that oil. Further, it's estimated by the International Energy Agency that on a global basis, the oil industry is underinvesting in sustaining capital to the tune of about $1 billion per day. This underinvestment isn't felt in 2024, maybe even 2025. But in 2026 or 2027, a systematic underinvestment of $365 billion a year impairs the ability of producers to maintain production. Let's look at what happens when you do that. There are two instructive lessons. PDVSA, the national oil company of Venezuela, has systematically underinvested in sustaining capital for 25 years, and they've reduced their productive capacity by 80%. The largest known recoverable oil reserves on the planet are in Venezuela, and PDVSA has lost 80% of their production capability, not as a consequence of geology, but rather as a consequence of deferred sustaining capital investments. The second example would be Mexico, Pemex, again, a state-owned firm, which again has milked their oil company for dividends to maintain politically expedient domestic spending programs, including, ironically, subsidizing kerosene and gasoline, subsidizing the consumption of products that they haven't spent enough time producing. In this case, much like PDVSA, the producing capability of Pemex, including cratering their best oil field, Cantoral, as a consequence of deferred sustaining capital investments, has reduced the producing capability of Pemex by 80%. One needs to look for oil and gas companies that are solidly profitable at $60 a barrel, that are able to, as a consequence of high free cash flows, reinvest sufficiently in sustaining capital investments and, if possible, in new project investments, so that they can take advantage of this systematic underinvestment around the globe.
So that leads me to a question then. Should an investor even touch or look at juniors then, because of just really where the price of oil is at, and that or they very well could run out of money before they could take advantage of this?
That's a function of how hard the speculator wants to work. Speculating in oil and gas investment, in oil and gas exploration, has been extremely good to me, but I grew up in it. I'm willing to do the work. I'm willing to make endless phone calls. I'm willing to take political risk. I'm willing to take technical risk. I'm willing to be wrong. Investors who aren't, metaphorically, ready to suit up for a rodeo shouldn't ride that horse. Speculation's been important to me. I need to say that I think the juxtaposition of risk to reward in the oil business is so good that right now, for most people, I would rather see them be investors than speculators. I think there's enough money to be made on the big stocks that you don't need to go down the quality trail too much, despite the fact that I do it.